Hello everyone, I'd like to welcome you to our second Cereals Conference live here, held in Chicago, Illinois. This conference, of course, is a mid-year wrap-up of the growing season across the Northern Hemisphere. We're holding these Cereals Conferences live, if you will, going back to our theme that there's too many ag conferences around the world, and that even though we had some of these conferences in Canada and Europe, and we may do them live at some point in person again, at the moment the grain landscape is such that as you all think forward, we've got too much supply, and the discussion, at least at these conferences, is still robust, but not as good as it was a few years ago. With that being said, I'm Dan Bossie, President of Ag Resource Company. I wanted to welcome you to the Cereals Conference Live. We're going to have some very good featured speakers, again, each spending about 15 or 20 minutes to discuss the grain markets in their speciality, and that being said, wheat, corn, or feed grains along with oilseeds. And then we may have a little bit of input in terms of weather as we finish things out. As we think about the grain markets this past growing season across the Northern Hemisphere, and we think about a new growing season emerging in the Southern Hemisphere, there's some themes that really come out. So I'm going to moderate the conference today and really set the stage, if you will, for the upcoming speakers, and hopefully they will provide some very good insight in terms of your opportunities both in trading and marketing as we look forward to the next year. Now, as we think about the growing season as it sits today, and we look at the economic themes of the marketplace, they're rather broad right now. And the one thing sitting here in the United States that we all think about, and I'm going to start in the middle of the page, which is rather unusual in these kind of forecasts, but again, as we think about the farmer, and I'm thinking now about the farmer dominated in US dollars here in the United States, he's looking at his net farm income being cut in half since 2012. I can't think of another industry, if you will, across the industrialized world in which that group has seen its income fall, or net income has fallen 50% since 2012. That's the state that we find the U.S. farmer in today, so he has this operational problem in terms of taking a ding to his balance sheet almost each and every harvest. Somewhere along the line this has to change, either through lower costs or higher income. We'll talk about that a little later in the presentation. As we also think about the big themes, we're fairly confident that the world political economic situation is going to be more volatile. In other words, the order that we've had over the last decade is now going to be changed to more disorder. Central banks have all been accommodative for the past 8 or 9 years as we went through the banking fiasco of 2007 and 2008. We're now coming out of that. The world central banks have invested about $29 trillion in what we call quantitative easing, QE. And we're now on the other side of that. And politically, we've got a lot going on. We've got Donald in the White House. We've got Brexit, North Korea. We've got a lot of things happening that are protectionist on trade. And so the markets financially are in a state of transition. So we think there'll be greater volatility, principally in the interest rate markets, some of the currencies, some of the metals and energy markets, which will have an impact on agriculture. We think U.S. and world crude oil prices have bottomed. We thought $44 was a very good bottom as U.S. end stocks of crude declined. World demand for energy is rising rather smartly right now. And so we think the crude oil market really has a good chance of making it up to $55 or $60. So there's that peg of support. And in the United States, we have a new biodiesel policy, which we'll enlighten you with later. World ag productivity is rising more quickly. I think if we look past the last growing season, you'll notice that we had some real problems in terms of Australia, in terms of their crop production due to weather. We had problems in the United States with weather, Canada. But at the same standpoint, the black swan event, which we'll talk about now, was Russia and its record large grain yields. Russian wheat yields are up 80% in just the last 5 years. Again, a big monument, if you will. When you think about Russia, you think about them, of course, being a world grain importer of substance and size 25 years ago. They're now the world's largest grain exporter. And so a lot of things happen in the Black Sea. I know Noel Fryer will enlighten you what's going on in the Black Sea and his view going forward. But that black swan event was having a Russian wheat crop this year of somewhere between 84 and 87 million metric tons. Harvest is still coming in, but it's a sizable crop, and the market is, of course, for wheat, it will be determined in the Black Sea. So the U.S. is the world's high-cost producer, the U.S. farmer. Somehow that has to change going forward. We think it takes 3 or 7 years of farm consolidation of some other aspects with price that'll happen. But again, I think the feature as we go forward, we've still got too much supply. If you're going to get bullish of agricultural markets and grains and oilseeds, it takes a weather event. So the coming 6 months is not unlike last year, where rallies hinge upon South American weather. As you think about commodities, we all know that they've been in a downtrend, and this is obvious as you look at the CRB chart that's accompanying here. But however, we're now starting to see some flattening of that. So we made a low going back in late 15. We're now seeing commodity prices starting to rise. And a lot of that is, of course, related to what we consider to be strong GDP rates, principally in the emerging markets. The world is really doing quite well in an economic perspective with the stock market in the United States, and now it's picking up in Europe and other sectors at a record high. We think the emerging markets, though, is really the story as, of course, their exports are starting to increase. Global grain and wheat and oilseed yields are holding above trend this past year, so this was very noticeable. You can see this line going back to 1964. And as we look at global harvested acreage this year, it was up 1.7 million hectares, 4.3 million acres, that being the 7th consecutive record. And so as we go forward, somehow the markets need to restrict grain seeding going forward. So you can see here, this of course is now the 7th record. In between these time frames, we oftentimes see world grain acreage going sideways. Of course, that last buildup from 1970 to 1980 was really the Russians coming forward with their grain bars, buying lots of world grain due to, of course, the collective farming system not working as well as it should have. As we look at world grain stocks this year, it is a decline. It's the first decline going back to 2012. And so there's a little bit of caution in how bearish one should be as the world sees slightly less in terms of stocks. If we look at stocks outside of China, it's even a little more robust, if you will, in terms of that decline. So again, one can be bearish of the grain markets, but I think we have to be a little careful if we get corn below $3.30, maybe wheat below $4 or soybeans below $9 in terms of how bearish does one want to be, because we do have stocks coming down. The big problem we see going forward, however, is that world grain trade, and I'm now looking broadly speaking, corn, soybeans, and wheat. Notice that soybean trade will be up, but if we look at the grains, wheat and corn, we're going to look at that trade basically going sideways to lower. So there's not a demand story. There's not a value added. There's not a policy here decision that is going to get in front of the grain markets that will give you a big demand story outside of China, potentially in soybeans. Now, we do have, of course, the political turmoil in the United States causing a drop in the US dollar. And of course, as we look at the Trump tax plan that has recently been proposed, that would only accentuate the budget deficit. And so the dollar's down about 9% so far, 9 to 10%. Politically, uncertainty is reigning in the United States. We've been trying to push through, of course, health care and other bills to no success. The administration, at least at this point, is still not fully staffed. And so as we look at the currency market, it is giving us some optimism that maybe we're going to start to reshuffle the deck internationally. And you can see that in the other graphic here, the Chinese yuan has started to appreciate accordingly. If we look at individual currencies and what it means for grains, you can see that the Argentinian peso has still been relatively weak. However, the Russian ruble and the Brazilian real has been stronger. And so it's the Argentinians that may be doing the expansion in the next few years. As we look at the Brazilian and the Russian farmer, he may expand a little around the edges, but it's not going to be as severe or as robust as it has been. Here's another graphic breaking down your favorite currency, if you will. And notice that if you look at the Russian ruble or the Brazilian real, that indeed those currencies have started to do better. Again, it's a basing formation. It's nothing that's going to be all of that bullish all at once, but we do start to like the opportunities in both of those currencies. Brazil has an election next year, as does Russia. We think that that will, of course, provide some upside velocity, which will pressure farm profitability in both countries. Now, again, we're not looking for big cutbacks in production this year, but it's something you do want to monitor going down the road. As we said, the big black swan event has, of course, been Russian wheat yields up 80% in just the past 5 years. It's astounding. It's not only a combination of weather, yield, and agronomic features. This is a really big deal as we think down the road, because as you look at the graphic here, notice Russian yields and how they've really just expanded. Even though harvested acreage is up back to the old highs going back to 8 and 9, it's the yields that have been so impressive, which has given Russia all of these grain stocks. Starting in the year, we're looking at record production in stocks, somewhere around 95 to 97 million metric tons. That means that if even Russia has a wheat crop next year of 70 million metric tons, they're going to still be exporting somewhere between 32 and 34 million metric tons of wheat. So it would really take, in a rather bad wheat problem in Russia, if you really want to get the world wheat market bullish because of the Black Sea. Just to point out, China's doing about the same thing. If you look at stocks of wheat in China, they're record large at 128 million metric tons, largely due again to rising yield. Notice harvested acreage in China has been going sideways. And so this phenomena about greater productivity on a global perspective is really catching hold in some of the old communist countries of Russia and China. And as you look at it today going forward, I would even say the United States. The United States this year did not have a very good growing season. This is June 1st to September 15th. Rainfall is percentage of normal. You can see the dryness that emanates from the northern plains stretching all the way down into states like southern Illinois and Indiana. This was not the growing season that U.S. farmers had desired. Yet as we look at something like soybeans that should have been very adversely affected by that dryness, yields according to USDA are only fractionally below last year, currently estimated down about 2.5 bushels per acre. Now we get another report in next week in terms of the October 12th USDA, WASDE, and NASS reports. That'll give us an update. But we are very impressed about U.S. soybean yields being to be just below 50 bushels an acre via the NASS estimate, and what that would mean going forward to U.S. productivity. Now, I'm not saying we're still at a point where we need to get rid of the weatherman, but I do think there's more, how should I say it, vitality in these crops when we do have adverse weather, and helping the United States out during the month of August was cool temperatures. As we look at the USDA's, of course, report from the September estimates, and we look at pod weights and pod numbers, you can really see what's happened here maybe genetically, in which pod weights have risen so sharply over the last 3 or 4 years. This is due to the Roundup Ready 2 soybean, which was introduced back in 2012. And so we think this is a genetic trend that will be with us for some time. We do expect a recovery in pod weights again in October. That's a historical trend that usually plays out. But what's going on here is, as we look at 4 years of record or above trendline soy yields in the United States, we're starting to really hone in on what we consider to be a genetic change, a change that may, of course, provide more supply in the United States for soybeans and corn going forward. Had you had a normal season this year, we wonder if the U.S. soybean yield maybe couldn't exceed 54 or 55 bushels an acre. And on corn, maybe that number's a new record, close to 180. So again, the genetic capabilities of these crops are quite remarkable, and it's the reason that U.S. farmers continue to pay these high, of course, prices for seed, now averaging somewhere close to $300 a bag. Lastly, I'll finish with one chart, and maybe there's a little bit of optimism in this. If we look at the Goldman Sachs Commodity Index and we take it relative to the S&P 500 index or ratio, you can see that we are down at levels that we've only seen several other times. Of course, going back to the late 1990s and that dot-com bubble when commodities were seen relatively cheap. If we also go back to the early 1970s, before the stock market really started their rally, you can see that commodities today are looking exceptionally cheap on a historical basis relative to the stock market. Now again, this doesn't mean that people are going to abandon stock positions and come back buy commodities aggressively, but I do think it's going to keep hedge funds on their toes, and they may look at some diversification out of indexes into commodities, which could give us some levity as we go into the new year in 2018. With that, I want to thank you. This is just an introduction to the speakers to come. I think we've got a very solid lineup here. We'll go to Noel Fryer next here and get his thoughts on the world wheat market. I would like to welcome as our first speaker to the podium Mr. Noel Fryer from the Fryer Report of Geneva, Switzerland. Noel's well known throughout Europe and Asia in terms of his research in terms of grain, particularly on wheat, and he's going to do the world wheat discussion. Now, Noel has been in the grain business a long time, I think going back over 40 years, tremendous experience. In fact, he set up the research division of Dreyfus going back many years ago. So with that, I'd like to welcome Noel Fryer to the podium. Noel, the podium is yours, and we're looking forward to hearing about your outlook on world wheat.
Thank you, Dan. Ladies and gentlemen, good morning. My name is Noel Fryer, and I'm going to be talking about world wheat this morning. A world wheat market which, in my opinion, for once is going to be at least as interesting, if not more interesting, than the corn and bean markets, particularly in the second half of the campaign. So let's start by looking at the current USDA World Wheat S&D. As you can see, we're still in this progression of building stocks, although at a slightly smaller pace than the previous years, despite another record crop. That picture changes a little bit when we take China out of the equation. When we take China out of the equation, world wheat stocks are in fact going to go down, according to the USDA, by around 9 million tons. And the other interesting point, if we look at the major exporters, is that excluding Russia, the major exporter stocks are going to go down about 13 million tons. So let's take a look at how the USDA is splitting up the current world exports from the 7 majors. They currently have a total demand for those 7 origins, which is pretty much the same as last year, around 157 million tons. But as you will see, we have some fairly significant differences of opinion with those numbers and that split. I'm going to start with the ones where we tend to agree, and the first one is Canada, where we have little real problem with either the USDA crop or the export number. We would say the same thing about Ukraine, 26.5 million, 16 million exports. The first one where we start to have a little difference of opinion is on Argentina, where the extent of the wet conditions over the last few weeks and months have meant that I would say that crop is at best 17. I would probably, if I really wanted to be aggressive, take it down to 16, 16 and a half. Argentina, like most of the southern hemisphere, you take the crop down, you take the exports down 1 for 1. Right now, I would take Argentine exports down to 11. It's only a small difference compared to the USDA, but you will see as we go further into the discussion, this becomes important. This is Russia. This is the big one that everybody is talking about. USDA currently has a crop of 81 million tons. We believe it's probably closer to 85. Their exports of 32.5 million tons would of course be an absolute record, and until a couple of days ago I was actually below that, because I believed that the Russian export capacity, which is finite, was not enough to maintain the kind of pace that we've seen so far. But over the last couple of days we have seen cumulative Russian exports now running 22% ahead of last year, and so we have raised our Russian export number to 33.5 million tons, with a big possibility, with a possibility that that number could get higher, because today there is more and more discussion that the Russian Black Sea elevators, export elevators, will increasingly take capacity away from corn and barley and push that into wheat. So that is something to bear in mind for the future. The EU, this is the first major downgrade that we have in terms of exports compared to what the USDA is using. And the logic for this is the following. A year ago, the EU had shipped, by this time of the campaign, about 7 million tons, which was 27% of the final number. This year, they've only shipped 4 million tons, which against the USDA's export number would be just 14%. So the pace pickup for the rest of the season would have to be extreme to make that number. That, in our view, is not going to happen, given the current price structure. You have now these prices may be just a little out of date when the slides were put together, but the spreads are still valid. French 11.5 protein wheat is currently about $15 a ton more expensive than the comparable wheat in the Black Sea, and that is why France is shipping to Algeria and West Africa, but pretty much nowhere else. That equates to about a 6 million ton demand number. France probably has a non-EU exportable surplus of about 11. Until those price spreads change, France will not export what it is capable of exporting. In the same kind of vein, German and Baltic 12.5 protein wheat is $10 to $15 above Russian 12.5 protein wheat, and for that reason, Germany and the Baltic have shipped just 1.2 million tons so far this season, out of what we believe is an exportable surplus that is 3 million tons less than last year. And finally, with regard to the EU, if you all remember the last gas tender, the Russian prices were $10 below Romanian prices. Romania has been almost completely priced out of the non-EU export market. So for all of those reasons combined, in fact, if I were really to put the number on it that I think, I would put EU exports today no more than 23 million tons, but in order not to get too aggressive, I'm still sticking with 25.5 million tons, which is 3 million below the USDA. The next origin is Australia, and this could be the single biggest problem for the market in going forward. The USDA currently has a crop of 22.5 million. ABAR is at 21.5. We are using, as you can see on the left, 19.5, but we know there are some major commercials down in Australia who are already at 18 and heading south. So the problem for Australian exports is not one simply of supply. If you are 18 million tons of production, then you are 4.5 below the USDA, and as I said about Argentina, Australian production declines comes also straight out of export numbers. You would be taking the USDA export number down to around 17 million tons, but the price factor is also extremely important in terms of Australia, for the simple reason that Australian wheat is so highly priced at the moment that the only demand it is getting is inelastic demand. Now, there are a lot of different opinions as to what inelastic demand is in Australia. The range is anything between 12 and 18 million tons. We are using 14 million tons. But to this aspect of the Australian market, you also have to look at what is happening in the domestic feed market. The domestic feed market is paying a premium for APW wheat to what the export market is paying, and that export market is already too expensive for the world market. So getting Australian wheat to export channels is going to be extremely difficult. Just as a little additional point, we point out that Black Sea exports to Asia during the month of August amounted to a record 2.8 million tons, and most of this was done at something like $50 below Australian prices, just to give you an indication of how tough it's going to be to get Australian wheat into the export channels. So to complete the picture from the USDA's point of view, they have 26 million tons of wheat demand in the US, but basis the numbers I've just been through, our numbers, and assuming that the world really does need 157 million tons of wheat from the 7 major exporters, basis our numbers, the US has to supply about 35.5 million tons. That's 9.5 million tons more than what the USDA is using. At the current US all-wheat balance sheet, which has end stocks of 933 million bushels, if you add on the 9.5 million tons, which is about 350 million bushels, you take US end stocks down to 583 million, which is already starting to get much more interesting. However, where the real difficulty occurs is the allocation of those additional exports amongst the US classes. Can you put any additional exports into the hard red spring balance sheet? Well, I think it's probably very, very difficult because, and again, these numbers were done before the change in the US crop, and that end stock will be down due to the abandonment. It is also worth noting that the US S&D is a June-May crop year, so those stocks are as of 31st of May. The spring wheat harvest is August, so you've got a couple of months of domestic demand at least to come out of those stocks. So today, it will be very difficult to put additional export demand into the US hard red spring wheat balance sheet, particularly as Canadian spring wheat is significantly cheaper up on the west coast. Can you put additional demand into soft red winter? Well, at current prices, I don't think so, because soft red wheat, French wheat, and hard red ordinary wheat, they're all about level money FOB, so soft red wheat has not done enough to take any additional export demand away from anything else. White wheat is the first one where you can start to add in demand because it's running about $30 a ton FOB below Australian white wheat, and we know it is already buying Australian demand into Asia. It's tough to put more than 25 million bushels in there, because at 45 million bushels of end stocks, you're already getting extremely tight. So the bottom line is that if you want to add 350 million bushels of export demand into the US balance sheet, you've got to put 325 million into the hard red winter balance sheet. That's going to take stocks down from nearly 600 million to about 140 million. That is a significant drop, and with the implications, or the apparent implications, both for futures, but particularly for the cash basis. So what does it all mean? How do we solve this problem? Well, first of all, Russia has to continue doing what it's been doing for the last few weeks, which is continuing to rise to price back in other origins. Notably, in the first case, it's got to price Romania back into the gas market, which was about $10 away at the last gas tender. France has to buy around 4 million tons of demand, which can only be done by taking the price spread against the Black Sea down, basis today's values, by around $15 a ton. But once again, the French market is structured such that for it to break, it usually doesn't break until the second half of the campaign, usually late January, February, or even March, by which time it may be too late for them to garner the demand that they need. Australia has to buy at least 2 or 3 million tons of demand compared to the inelastic number we were using. But as that crop keeps going downhill, this becomes increasingly difficult. Soft red winter has to buy demand away from hard red winter and French wheat, and corn has got to continue to price out feed wheat, particularly from the Asian markets, which it's been doing increasingly for the last few weeks. If you look at feed wheat in the Black Sea, it's currently close to $20 above corn prices. And maybe Russia really does have to sacrifice corn and barley exports on a large scale so that their wheat export potential could maybe get as high as 37, 38. Because if the USDA demand requirements from the 7 majors is correct, then we have a significant problem with finding those supplies. It's interesting to note that we were talking about a 350 million bushel increase in demand in the US S&D. The maximum change of the USDA's US exports from the September report to the final report is in fact 260 million bushels. I forget which year this was, but that's the biggest change the US S&D has seen in wheat exports from the September report to the final number. And this is against our 350 million bushel number. So you can see there is a lot of work to do, there are a lot of balls up in the air, and there are some significant changes to be made to the world export matrix in wheat. Dan Bassey mentioned earlier the phenomenon that is Russia and that it has become over the last few years, so I'd just like to add a few points about Russia going forward, because this is without a doubt the single biggest new kid on the block in terms of the world wheat market. This is a graph of Russian wheat yields as a percentage of EU wheat yields. As you can see, it was kind of flat for up until about 5 years ago, and then as Dan said, it just skyrocketed over the last 5 years. We went from 60 million tons 2 years ago to 72 million tons last year, maybe 85 million tons this year. And there is no reason to expect this to change without a significant weather issue for several years. Why is this the case? Well, first of all, Russia has a low cost of land and a low cost of production. And if you have the outlook for crude that I personally do, here I disagree a little bit with Dan. I'm not particularly bullish on crude long term for various reasons, which I won't go into right now. As you know, the Russian ruble is pretty closely linked to what crude does. What has been interesting the last few weeks is that contrary to what would normally be the case with the ruble having been firm, that did not depress the interior price. In fact, it was the interior price that kept stable or went higher, and that translated via the firm ruble into higher US dollar prices. So the yields are going higher, and the farmers have had 3 very, very good years in terms of price, thanks to the currency and the world market, and the yields, and they are just going to continue to plant. The big unknown, probably in terms of the Russian wheat market, is to what extent the government and private industry and private investment can improve the infrastructure. This will grow, it has to grow, particularly in the interior, in terms of rail cars, etc., and also in terms of storage. And we understand that there is an increasing interest, big time, in silo bags. Today, Russia faces an 85 million ton crop and a 40 million domestic market, has a 45 million ton export surplus. Bear in mind that last year they exported just 27 million tons. That is 18 million tons above what their record export number has been so far. That's the extent of the impact that this country can have on the world market. And just as a final little point, I would show you that the French cost of production, which is fairly common to most of northern EU, currently is around $165 a ton for wheat, or about $4.50 a bushel. This, of course, is way, way above the Russian numbers, and there are clearly in the coming years going to be some major changes in the Western European and the Black Sea markets, because the balance of power has been shifting for many years, but that balance of power shift to the Black Sea is getting faster rather than slowing down. I think we will see some significant structural changes in the market in the years to come. I didn't put it on this slide, but I think there is also a potentially very important aspect which will come from Brexit. When the UK farmer no longer gets his subsidies, we do not know what is going to happen to production levels there, or how that will impact the overall EU market. Just to wrap up, there are obviously some big changes to come, and there are some potential big moves in the world export matrix. This is probably much more cash orientated as far as prices are concerned than it is futures orientated, but I think that we are going to have a very interesting second half of the campaign. Thank you.
Noel, I want to thank you very much for that great presentation. Can we all give Noel a hand? Thank you again for coming all the way to Chicago, and we appreciate it very much. Our next speaker will be Dr. Bill Tierney. He'll be up in just 1 second. At this point, we'd like to introduce Dr. Bill Tierney. Bill's our Director of Research here at AgResource. Just to show you the depth of experience that we have, Noel's been in the industry for 40 years. Bill's been in the industry for 35 years. I've been in the industry for 38 years. So we've all been doing this a long time, and hopefully you appreciate the depth and experience that each speaker brings. Bill's been, of course, in charge of the grains, chief economist at WASDE, in charge of the grain report. His depth of knowledge of the grain market and oilseed market is really something remarkable, and I know you're going to enjoy his presentation as he outlines the opportunities in the world soybean market. Bill, the podium is yours.
Thanks, Dan. Well, as Dan said, my responsibility this morning is to go quickly over the global soybean outlook. I cannot really cover the entire oilseed complex. I'm just going to focus on soybeans. That means that most of my comments are reference to soybeans and soy meal. If we actually dealt with vegetable oils, then we'd have to be talking about the palm oil outlook, and I'm not prepared to do that at this time. So to get in my presentation, what I'm going to do first off is to review the global soybean S&D as it was presented in the September WASDE projections. Now, unlike the outlook for global wheat and feed grains, where a large portion of the global production is fairly well understood, because a large portion of global production, particularly the exportable surplus, is produced in the Northern Hemisphere. With respect to soybeans, only the U.S. soybean crop has been produced, and there's still some question as exactly how large that is. Most people feel that with the October crop estimate, we'll probably nail that down within maybe a bushel of what the final number is likely to be. However, we're just now beginning to plant the South American crop, which accounts for roughly 2/3 of all exports of soybeans and soy meal. So to a large extent, it's somewhat still of a guessing game, but we're going to use the September WASDE, and we're going to discuss what the implications are using that number. I'll also review the exporters, specifically the exporters soybean S&D, and then I'll talk about the implications of the exporters S&D, and then I will review just the U.S. soybean S&D. The reason for that is people say, well, since we don't know what the South American situation is, what are the price implications if we just use the U.S. soybean outlook, again, as it was outlined in the USDA September WASDE. So we'll look at the price implications of that, and then we will finally look ahead to the October WASDE and say, well, what if the USDA tightens up the balance sheet or perhaps increases surpluses? What does that mean for prices? So let's get into my presentation right now. Again, these are numbers strictly out of the USDA September WASDE. You can either fade them up or down depending on what your biases are. I think that if you take a look at the long run accuracy of the USDA's numbers, I don't think anyone has numbers that are better than that, and I think there's some evidence to suggest that USDA's numbers are the best available at this point in time. So using those numbers, we see that the global soybean crop is expected to be down 1%, even though total area is up slightly from last year. The USDA's assumption of trend yields, or a return to more trend yields, results in total global production down roughly 1%. But even if production is down 1%, the record carryover from last year, which is a fairly well-documented number, unlike the situation where we were looking at global stocks of wheat or global stocks of corn, where China's stocks are a significant portion, if not in the case of wheat, let's say over half of total global wheat supplies. That's not the situation for soybeans. Soybean stocks are very well documented. Soybean stocks are believed to be accessible to the market, unlike Chinese stocks. And when you add those stocks to production, we end up with global record large supplies of soybeans assumed going into this new marketing year. What about usage? Here again, the USDA is assuming that global soy use will be up about 4.4%, and crush's share, the crush share of total use, has been relatively flat at about 87–88%, going on now about 4 years now. What about soybean trade? Here again, this is trade of soybeans and soy meal in meal equivalents. USDA is expecting trade to be up about 3.5%, and we are looking at bean exports as a percent of bean and meal exports being roughly 70% of that. So total trade, roughly 70% is soybeans. The remaining 30% is trade in meal. The USDA is assuming that even after taking into account a fairly respectable growth in demand of 4.4%, we still end up with next year global stocks slightly larger than global stocks this year. So we had record soybean stocks at the end of the last marketing year, and going into next year, we have a slight increase in that. Again, based on the assumption of near trend yields for Brazil and Argentina, and using USDA's production numbers from the September WASDE for the US. However, if you take a look at the stocks to use ratio, which I think is a more appropriate number to look at when trying to model price response, we see that this past year we had record global stocks to use of beans and meal stocks. So we had record global stocks to use of bean and meal stocks, roughly 34%. USDA is projecting that to decline slightly this year, but it'll be the second largest stocks to use ratio on record. Essentially, what this means is we have got a huge surplus by any measure going into this year, and we're anticipating that we'll have nearly the same surplus coming out of this year. This is not a bullish scenario. If anything, it's a bearish scenario because it's built on the assumption of trend yields in South America. Yields could be below trend or yields could be above trend, but I think if you look at individual South American yield behavior, there's a decent argument that some of the same genetics and other factors which have been pushing U.S. soybean yields above trend in each of the last 4 years, somewhat the same genetics and the same agronomic practices are pushing yields above trend. Be that as it may, USDA is assuming trend yields for South America. If it's not trend, if it is above trend, keeping in line with what we've seen the last several years, then we could be looking at a significant increase in ending stocks based on the assumption that we made, USDA has made with regard to trade. So, bottom line, we've got record stocks. We're going to keep stocks nearly at that level. There's a risk that if South American yields behave like U.S. yields, we could actually see above trend yields and even larger exportable surpluses. Now, let's take a look at just the stocks to use of the major exporters. You get a slightly different look there. Here we see that exporters' stocks are not at record levels, as are global stocks. USDA is projecting stocks to be unchanged for major exporters next year compared to this year, but however, stocks have been rising for the last 6 or 7 years. What does exporter stocks to use ratio mean in terms of prices? This is a model that takes a look at the final exporters bean and meal stocks to use ratio relative to the USDA's forecast for U.S. season average price. The green triangle represents what the September WASDE forecasted prices to be, $9.20, and it shows that the USDA's forecast falls right on the estimated regression line when you regress final U.S. soybean price to final global stocks to use ratio of the principal exporters. However, you notice the R-square is only 0.53, and therefore it's not something that you would want to bet a lot of money on, but it does show that there's a fundamental relationship between the exporters' stocks to use and U.S. cash prices. But the question is, can you trust global stocks numbers, particularly stocks numbers for Argentina and Brazil? This chart shows what the USDA has estimated the soybean stocks to be as a percent of use on local marketing year for Argentina, Brazil, and the U.S. You can see that for this coming year, Argentina's stocks are projected to grow even further to a new record level, nearly 35%. we can also see that U.S. stocks are projected to grow, and Brazilian stocks as a percent of use are projected to decline slightly. So because of the uncertainty about South American stocks and what it takes to make those stocks available to the marketplace, some analysts have suggested that you just look at price outlook relative to the U.S. balance sheet. And this chart shows what the USDA September, only the September WASDE was projected for stocks to use. The orange column represents this year's, and the blue columns represents the previous year's September stocks to use ratio. Here, if you take a look at what the November soybean futures price is 1 week following the September WASDE. So 1 week is more than enough time for the market to digest what the September stocks, September WASDE implies. And so what we see here is a better performing model. The model has an R-square of 0.71, and it shows that the USDA's September stocks to use ratio was 11%, and 1 week later the price was $9.68, and we can see that prices are a little bit above projected. In fact, they're about almost one standard deviation or one standard error above the projected model. WASDE, what if the October WASDE is identical to the September WASDE in terms of its forecast of stocks to use ratio? Here again, this chart shows what the October WASDE stocks to use projection was every year since USDA first started back in 1973. The orange column represents the 11% stocks to use projection that USDA had in September. Well, what if they keep that same projection in October? Again, no change in the stocks to use projection. Well, here again, the model performs a little bit better. If you look at the November soybean futures price 1 week after the October WASDE was released, you'll see that the R-square is about 0.78, and the price forecast is about $8.75. So the market is projecting the model is projecting a price of about $8.75. A few weeks ago we were at $9.71. So here again, prices seem to be a little bit on the high side, about one standard error above what is the projected price if we have the same stocks to use ratio. So what if the stocks to use ratio is higher or lower? Let's say stocks to use ratio is 10%. The model is forecasting $9.17. What if it's 9%? The model is forecasting $9.67. What if the stocks to use ratio falls to 8%? The model is forecasting $10.25 1 week following the report. On the other hand, if stocks to use grows, let's say to 13%, the model says the prices should fall to around the $8 level. So, in conclusion, if you think the USDA September WASDE is roughly correct, U.S. soybean stocks will rise and global stocks will rise to a new record. Soybean prices right now are on the high side, but within a standard error of price model forecast based on the current USDA stocks to use projection. As usual, South American crops will likely determine future price direction. Other unknowns are the Argentine soybean stocks really there, and what price and when will Argentine farmers begin to sell the record stocks that they've accumulated? The second question is, what will China's imports be? The evidence suggests that USDA's export projection for old crop exports at 92 million metric tons is maybe 1 million to 1.5 million metric tons too low. That suggests that their new crop projection of 94 million metric tons is also 1 to 1.5 million metric tons too low. In addition, historically speaking, USDA in their September WASDE underestimates U.S. soybean exports, usually because they underestimate China's imports. So, in addition to South American weather, which I think will be the dominant factor determining future prices or price changes from current levels. We also have the unknown of Argentine stocks, and we also have to watch very closely what China's soybean imports are. Thank you very much.
Our next speaker will be Ben Buckner. Ben is the grain analyst at Ag Resource. He's been with us a little over 6 years, and he does a great job in analyzing the corn and wheat markets. I think you're going to enjoy his summary, particularly on corn, and whether or not he really believes that the corn bear market is over. Ben, the podium is yours.
Well, thank you very much, Dan, and hello, everyone. I know this is a provocative title for the corn outlook, but we're trying to identify long-term trends. We care less about the October WASDE or the November WASDE, but how have things changed, say, in the last 12 months? And what is the future for the next 2 or 3 years? So we'll just get right into it. And honestly, the near-term outlook, 60, 90 days, the corn market is not going to do a whole lot, as evidenced by trading this week, especially where we've seen just pennies traded per day. And there's a lot of corn. You can see that as of last year, old crop, which we just got out of, a record amount of corn globally. And that's not news, that's not new bearish information, but what it does do is it puts us very, very far down this price to stocks to use curve, as you've seen other presenters talk about. And the issue isn't so much that we're moving up the stocks to use, it's that it's very, very flat. The best fit of this relationship is not linear, but rather exponential, and so it takes a lot of change in bushels and tons to really move up and down this. So in a sense, we're kind of stuck. So to illustrate this, let's say, for example, the October WASDE does cut yield and cuts U.S. corn stocks to use, a full 2%, a sizable change. According to this model, that is worth just 20 cents a bushel for the season average cash price. Conversely, if we were at 11%, the U.S. balance sheet was a bit more tight, and we take the same 2% change in stocks to use, that's worth 80 cents a bushel on this model, and so on. So as we move towards zero in stocks to use or infinity, you get these changes in relationship. So that is why mostly the corn market has been so dull over the last 2 years. We know we have a lot of crop and inventory, but it's just that it takes major changes to move the market, and that's just human nature. So you can also see that the 2017 balance sheet, as it stands in September, is very dull itself. Slightly higher stocks, slightly lower season average cash price forecast, but nothing to get excited about. But again, we're thinking long-term here, and has there been an inflection point in this long-term bear market that we've seen since really, the latter part of 2012? So how we got here, of course, is currency in addition to some weather, but I'd say it's mostly been currency related. So since 2014, prices in the US, corn and wheat of course, were down sharply. Everywhere else, they are up sharply and everyone's making a lot of money. So despite the US farmer being in pretty dire straits financially, there's been a boom in the farm economy everywhere else. Again, this isn't news, but it is highlighted in some of the world S&Ds. For example, as of 2015, we had then record corn stocks on harvested area of 179 million hectares. Usually when you have too much grain, price goes down, we start to contract and the cycle goes on. But then 2016, we added more inventory to the world corn balance sheet and on more harvested area, 184 million hectares. And not only that, but as we move into new crop, we've got record beginning stocks. And not only that, but they've been going up almost every single month since really late 2016. So starting with February, record corn stocks projected, and every single monthly WASI, it just keeps getting higher. We keep finding more corn, albeit slightly, but it keeps getting bigger and bigger, this ending stockpile that we've got to work through now that the new crop year is upon us. And so on, every single month until September. And on balance, we've added 9 million tons to the world corn balance sheet just simply with USDA minor revisions. But for the first time, as Dan mentioned, we're seeing lower corn grain stocks. And will this be sort of a lasting trend, I think is the question that we all have to ask. It's not news and no one is unaware that there's a lot of corn today. But as stocks are going down and world prices are already at decade lows, what is the opportunity on the short side of the market? Now, narrowing in and getting a little bit more specific, South America, who like wheat, Russia and wheat, is a major driver of price now, but that market appears to have bottomed. Basis in Argentina is on this graphic, and you can see that once harvest starts to occur, we know a little bit more about Argentine yields. Basis either moves sharply higher or sharply lower. Last year we had pretty bad production in South America, Brazil mostly, but Argentina too, and so we had basis premiums increasing. This year, production was pretty normal, record crop actually, and so basis premium started to decline, but you can see that this follows the general seasonal pattern rather well, even up to this week. And so the bear market in Argentina's corn cash market has ended for now. We'll see what the next year's harvest is, but for now they've fallen to prices below the Board of Trade, found demand, and now we're moving up. Currencies also will be the biggest issue. So, in spite of ongoing political chaos, if anything, political uncertainty has gotten a little bit worse. But since the IMF in its April report raised Brazilian GDP growth for the first time in a long time, raised it above the estimate of last October, and we're expecting positive growth there beginning in 2018 and probably beyond. So these emerging markets are coming back, and as the economy improves, we've seen real fundamental strength to currencies there, and also fundamental changes in those relationships. So the real has strengthened, the dollar has weakened, and that is very, very important to the 2018 balance sheets and beyond. Since economics, it's all about incentive. And how have those incentives changed over the last 9-12 months or so? So previously, the weak currencies still in Argentina have really buffered against losses at the Board of Trade. But now it looks like things are coming a bit to be more normalized, and that pressure is not just being placed on the U.S. farmer, but also worldwide. Not so much Argentina, but certainly in Brazil. This graphic indicates the percent change in farm gate cash prices since last August. And you can see that no one is doing better than they were a year ago. In the case of Brazil, potential revenue is down 45%, which is a big, big deal. And so to think about this too, and display this just a little bit differently, you can see that the bull market in farm revenue for growing corn in Brazil has ended. And so now we're at 2-year lows in potential revenue just as the first crop there is being planted. So pressure is being placed on the Brazilian farmer. There's no longer as much incentive to expand area. And of course, it's still apparent in the US, where we're also at 2-year lows in cash prices today. So who's making money and who is going to maybe not contract, but who is going to expand seedings when profitability is down so sharply? And it's been changing so much in Brazil especially. And on the other side, we are starting to see a boost in crude oil prices, and that is because on balance, compared to the last 2 years, we are using a lot more crude oil and gasoline in the US. We're also exporting more than we have in the last several years, and so we haven't found that balance where we are a net exporter, which has been forecast for a long time, but our net imports on a weekly basis is getting smaller. And so this is important. If the crude market keeps going up, that will further strengthen currencies in crude-reliant countries, and it also is very, very helpful to the U.S. biofuel market. So spot ethanol production margins are a far cry from record levels, close to where they were a year ago, but certainly positive. This is a futures-based margin, and anytime this is above 30 cents a gallon or so, you're going to see a response from the ethanol community. But not only that, so we're seeing record ethanol production already, but we're starting to see more ethanol use. So supply and demand balance is being found. You can see that gasoline's premium to ethanol has been intact now all summer and compares to the same period a year ago, the September to March 2016-17 crop year, where RBOB was priced at a significant discount to ethanol, and all that was keeping ethanol being used was really the RFS mandate. But now the free market has kind of taken over, and so will there be more discretionary blending, and will there be more plant capacity put online? And we've already heard of talk that in the next 12 months we may see 1 billion gallons or so added to plant capacity. Not new plants, but existing plants expanding production runs. And I think that's partially because the big players in the ethanol market now want to drive everyone else out, and the way you do that is to produce more, kind of margin to be damned. We're also exporting ethanol for the first time in a long time, which is very, very important because, of course, there is this perceived blend wall. It's 10% of whatever we consume in gasoline, and that is still true. But if we start to export ethanol abroad, then the blend wall is, on paper, essentially infinity, or it is at least being raised, and we don't know exactly how high it is. So we've seen incredible export demand in the ethanol market. And even as of last week, and despite Brazil adding a 20% tariff on imports from the US above 600 million liters, non-domestic use ethanol disappearance is still going on at the pace it has been all year. It's a record. It's even above last year, which was very, very impressive in itself. So whether it's going to Brazil or not, it is finding homes outside of the US, and again, that is raising the perceived blend wall and boosting corn demand use for ethanol. And while the world has been planting more and more soybeans, wheat, corn overall because of currencies, we've been ignoring the lesser free feed grain stocks globally. And so rather quietly, we've lost a lot of supply of combined sorghum, oats, and barley, and not just in the US, but everywhere. So record low stocks to use, in fact, in 2017. This has been a data point kind of been ignored in recent WASDE reports. But if the market chooses not to buy lesser feed grain acres, this trend will only continue in the next several years, so corn has less of a burden placed on it by higher feed use or ethanol use of sorghum, feed use of oats and barley, and even wheat. And as mentioned in the wheat outlook, wheat prices are going up, which is significant by itself for corn, but also compared to a year ago, it's much, much different. You can see that last September, corn had hefty premiums to Black Sea barley and Black Sea feed wheat, and that we did see, importers in East Asia who care less about quality and specific crops start to buy this huge surplus of feed wheat, but no longer today. Now it makes more sense to buy corn, so it probably will be South American corn in the near term that goes to these East Asian feeders, but overall world corn demand, trade especially, is probably being understated by the USDA just based on price relationships. And the trend for feed grain prices, wheat especially, is not bearish, not at least through the end of the year. And so far it's been following this trend pretty closely, and should we get to $185 or $188 a ton in Black Sea feed wheat FOB offers, that is at least comparable using today's Gulf basis to 410 December Chicago corn. Now we probably won't go there very quick, but only above 410, maybe $4, do we start to lose this incremental demand into Asia, corn as a whole. And middle and weak seasonals too are very, very strong in spite of this year's record Russian crop, record Russian ending stocks. The trend is for a higher price trend into the end of the year and really through spring as logistics get constrained because of weather. And so if this trend holds and Russian wheat eventually tests $198 to $200 a metric ton, there's going to be some kind of pull on corn also. So it's all about incentives. There's no longer as much incentive to plant. There's more incentive to export corn to Asia, to use it in ethanol, to export ethanol. And so all these things I think are working for the price of corn longer term. And so as kind of a thought experiment, since there is not the incentive to plant anymore, forward. Let's leave harvested acres globally unchanged from this year for the next 2 years. So there's a lot of information on this slide, but what this is otherwise is just trend yield, 5-year trends in consumption. And you can see that simply using the Excel function, no opinion on my part. Perhaps the probable scenario is pretty steep cuts in world corn ending stocks should weather be only normal, and if the market is content to not buy new acres moving forward via cheap prices both in Brazil and the US. The major exported corn balance sheet, which is a key driver of price, looks very, very similar. It's not as intense, but you can see that if we're not buying new acres, again, acres won't be down, producers produce, but if we're not buying new acres, you can see that the most probable scenario is that we start to lose corn inventories worldwide and in exportable positions. And this seems to fit in line with history. You know, bear markets are lasting, but not usually beyond 2 to 4 years, and so 2016 would have been the 4th year of this long-term bear market, and they're all different, but this year we think it's because of currency that we start to correct here. And do the next 3 or 4 years hold ever falling corn and wheat stocks, and what does that mean for price? Higher lows, higher highs is all we can say now. It's not an overly bullish outlook, but it has changed enough that we think the peak of the bear market occurred in August of 2016, and now we're looking for new direction. So to summarize again, corn market won't do much in the next 90 days. Stocks use is still too big. We're not moving up or down that curve fast enough just yet. And it will take time to find this new demand into Asia. Biofuel production will be a long-term thing. But it is all about incentive. And so unlike last year, there is not the incentive to expand seeding in the US and Brazil, which is new, but there is ample incentive to find at least incremental uses for the crop, whether it's ethanol or feed use to East Asia and elsewhere. And again, maybe in the near term, world wheat prices are rising, and the feed, wheat, and barley outlook is positive into year end, so corn doesn't have to deal with that competition for feed use this year, which it did a year ago. So simply put, the world market is clearing these massive inventories, albeit very, very slowly. And so what's next is, will South America produce a record crop again? We are seeing a development of La Nina, which has mixed results in Argentina. The last 2 La Nina events have been very bad. And can a wet May, June be repeated in northern Brazil, where it's basically the tropics? And whether there is just highly, highly variable. They've been blessed, 4 of the last 5 years with abnormally long wet seasons, which extend into the first part of June, but will that be repeated? And the point there is that Brazilian corn crop can fluctuate by 15 to 20 million tons pretty easily. That is not necessarily a shock or a surprise. And then finally, the bear market did peak in the summer of 2016. We've been sideways since, but what do we do next year and the year beyond should prices stay cheap? And we think that's higher due to the loss in acreage. Thank you very much.
Our next speaker hails from Brazil, and Tarso Veloso is our head of Brazilian operations at AgriSource Brazil, and he's here to give us an update on the planting outlook for the upcoming growing season. Now, Brazil has just started planting corn and soybeans. We expect that plant pace will kick out into high gear here in October. But a general standpoint, it's been a dry start. Tarso will give us some ideas about what Brazilian farmers will be doing. Tarso, the podium is yours.
Thank you very much, Dan. As Dan mentioned, I'm going to be trying to explain how the planting season starts in Brazil and develops. We're going to go through a little bit of currency and also the political situation in Brazil and how that might and will affect the currency looking forward next year. The first slide shows us the planting times in Brazil. We can see the Mato Grosso and Paraná starts in September, but they really catch up in October or November. All other states, they move ahead until almost April in one state far north in Brazil. This is a map where the most concentration of soybean production is in Brazil. We can see there is Midwest, Mato Grosso, and south of Brazil. And this is the map of rains. We know that the market over the past few days are talking a lot about the lack of rains to start planting in Brazil. And we can see that rains are coming. And it's not every single year that rains start on September 15 when farmers are allowed to plant soybeans in Mato Grosso. So most of the years they do wait a little bit to start planting, and that can affect the soybean, the safrinha corn and the winter corn crop in Brazil, as happened in 2016 in Goiás. We have a chart from what happened during the precipitation in April and May in Mato Grosso. We can see that it was above 16, but it was the lowest since 2011, which means that the soil moisture is not enough in Mato Grosso to start a planting unless we see some heavy rains coming as we have in October. This is the planting pace as of right now. We know that it's only at the beginning, but we can see that Mato Grosso, for example, only planted 0.1% of the area compared to an average of 2.5%. While in Paraná, they only planted 1% against an average of 2%. The South American acreage, as Ben Buckner told before, is increasing year after year, and because Ben already said, because currency is helping producers in Brazil to profit even when the CBOT is in lower prices. We have the soybean exports from South America. Again, even Brazil and Argentina, they're increasing in a high speed their crops. It's easy to remember that 2 years ago, Brazil produced 96 million metric tons. And right now this year, it's gonna be 115 million metric tons. Of course, we had a weather problem, but as Ben mentioned, it's easy in Brazil and in South America to have these huge fluctuations depending especially on price and currency. Last year, the Brazilians have a lucky of having political problems, especially with the impeachment of the former president Dilma Rousseff, which made the currency skyrocket from normally $1 for 250 reals to above 40 reals in a period of a couple months. After the process was done, real came back to where it belongs. Right now it's 1 for 3 reals, which is averagely is where it should be, but Brazilians are hoping that the political crisis in Brazil right now will make the currency further devaluate again against the dollar. Ben already mentioned how we can have a contraction of acreage in Brazil, especially because nowadays in Mato Grosso, the price for a 60-kilo bag of corn is below the production costs. So farmers in Brazil, they don't have as much storage as US farmers, and they have to wait. They have to sell right now and lose money, or they usually just pile the corn outside since wasn't yet until last month a rainy season in Brazil. But it's a problem that especially farmers in Mato Grosso have, since Mato Grosso produces roughly a third of the soybean and corn in Brazil. Here we have a few estimates, projections for the next crop in Brazil. It's too early to start talking about it, but we do forecast an increase in a soybean area and a slightly reduction in a corn area, especially because of the depressed prices. And as we know, as Ben mentioned before, the export pace in Brazil is record, and it's helping Brazilians to reduce the the carry on for next crop. Brazil's economy, as we can see, this chart is being, since the crisis in 2014, Brazil is going low. Unemployment rates are all-time high. We have more than 13 million people unemployed in Brazil. But over the past couple months, after the former vice president and now president, after Dilma Rousseff was impeached, Michel Temer, after he took over, he approved a couple austerity measures to try to reduce Brazilian deficit, and the economy is growing. The inflation was 12% last year, and this year will be below 3%, and also the unemployment rate is coming down a little bit, which is represented on how we forecast that Brazilian GDP will go up. As a politics in Brazil is always interesting to try to explain how things happen in Brazil, because one week we have someone arrested, the other week he's free again, 15 days later he's always arrested. We have on a slide you guys can see on the top left, we have Michel Temer now, and he's facing a lot of problems with his ministers and politicians close to him. From this initial group of 4 or 5 ministers, 3 are already in jail, and Temer is suffering his second complaint in Congress. First one 3 months ago was declined by Congress, which the lower house must vote a yes or no for the request for the Supreme Court to investigate Temer. The second complaint was delivered this week, and among this process, Real already devaluated a little bit, but the market sees that even if Temer is out of the office, most of the bills that were passed in Congress are already taking care of the economy, trying to reduce the deficit. So it's not a matter of who is going to be unless the measures that the market wants to see are approved. And the 2 pictures below is one of Temer's most close allies, Gedel. And Gedel Vieira, the federal police found 51 million reals on that picture inside the bags and cardboard boxes inside his apartment with his fingerprints inside on the money. So he's in jail right now, and Temer is losing a little bit of the support that he has in Congress. Will he be impeached? It's hard to say, but with an election next year, it's most likely Temer will keep in the job for another 12, 14 months, and then he'll pass away. And I think that when we come closer to the election, depending on who is competing to be the next president of Brazil, may interfere with the currency. It's also important to remember that Brazilian Central Bank today is getting closer to an all-time low benchmark interest rates. Usually farmers in Brazil, they have to get loans to pay for their costs, inputs, and investments. Brazilian government subsidizes a little bit of that, and if the benchmark rates are high, as they used to be 12, 14% a year, the government has less room to try to help farmers to pay less. Right now, with 7.5%, and they're forecasting that by the end of this year, the benchmark interest rate will be 7%, it is very likely that farmers will have access to cheap credit, which will help them to invest more in machines, storage, and buy more inputs, looking forward to the next crop. Right now, Brazilians are planting the soybean crop. They will begin harvesting January, February, and March, and then they will plant, and right after harvesting the soybeans, they will plant the corn. And we will have to wait and see how cash prices in Brazil are behave, and if farmers will be willing to expand their corn crop area this year. Thank you very much.
I want to thank you for joining our Cereals Conference live today. I hope you found the information enjoyable. We talked about the wheat market, which may have an opportunity in this last half of the crop year, November forward. We talked about Russia in terms of its logistical concerns. Bill highlighted the oversupply of soybeans and potentially here in the United States what needs to happen. Ben looked at a possible bottom in the corn market, which would be interesting if it is. And Tarso highlighted what's maybe happening in South America. Lacking today or missing was Scott Yuknes, our climatologist. Scott has been so busy, as you can imagine, with the hurricane season across much of the tropical areas of the Caribbean and the eastern U.S., southeastern U.S., that he couldn't make it today. But we're going to include a little pre-recorded snippet of what he thinks of weather coming up for South America and the United States this winter. So it won't be live, but hopefully as we run this video, you'll get a feeling of what he's looking for in the upcoming growing season in Latin America. My name is Dan Bossie. Again, thank you for joining us. We hope your trading and marketing year is kind to you as we look forward to 2018.
Hi, I'm Scott Yuknes for Climate Impact Company, and welcome to the latest Cereals Conference. Today we'll be talking about global crop climate for 2017-2018. Today we're going to start the presentation with the latest ENSO forecast. La Nina is developing. How long will it last, and will it be intense? We'll also take a look at the global sea surface temperature anomaly forecast governing the climate forecast that you'll see today, including the analog years. Then we'll move into the harvest forecast for Argentina and Brazil and also Australia. There's a big drought down there. There's a lot of concern about that. And then we'll take a look at the winter outlooks for Europe, Russia, and the United States, followed by the planting season for next spring. We'll also take a look at where the upper ridge position should be for the upcoming summer season in the Northern Hemisphere. So let's take a look at the sea surface temperature anomaly forecast. What we're looking at here is the December, January, February forecast using the North American Multimodal Ensemble. That's the most popular global SSTA forecast model. A lot going on there, and a lot of this will have to do with the climate forecast you'll be seeing in today's presentation. First and foremost, there is a La Nina forecast for the Northern Hemisphere winter. It looks like it will peak during the midwinter season, and it's prominently displayed on this forecast depiction, that big area of cool sea surface temperature anomaly in the eastern equatorial Pacific. We're not expecting the La Nina to be that intense. It does look like it's going to be fairly short-lived and ending once we get into the new calendar year, but nevertheless there and developing over the next quarter or so. Let's take a look at some of the other SSTA regions which are more prominent in the climate forecast over the next 3 to 6 months, beginning with the North Atlantic. It's very warm. The Atlantic multi-decadal oscillation is in the positive phase and quite strong. This has been a big contributor to the hurricanes that we've seen in the North Atlantic the last couple of months. And that pattern is going to continue right into Northern Hemisphere winter. That means Europe is going to be milder than normal for the upcoming winter season. To the north of Europe, the Norwegian Sea looks like it will be free of ice once again this winter. That means that the lower atmosphere will be warmer than normal, and with time, that warmth will feed the upper atmosphere and lead to high pressure blocking. So that implies a negative North Atlantic oscillation potentially for the upcoming winter season, and that means that the middle latitudes can be cold and snowy. We're not exactly sure where the setup is going to be for that. Most likely the Midwest, Central United States is the lead candidate, as you'll see in our forecast today. Elsewhere, the Pacific Decadal Oscillation is in the neutral phase. That means that the big ridge over western North America is unlikely to develop for this winter season. And an Indian Ocean dipole right now looks to be a borderline positive phase. The forecasts are officially neutral phase, but that's an area of concern for us. If you notice on the chart, there's an area of cooler than normal water to the west of Australia, and that signifies a potential positive phase of the Indian Ocean dipole developing. If so, the drought condition that's in Australia now will continue and worsen. Meanwhile, the La Nina indicates that a wetter scenario is possible over the eastern portions of Australia. So it's a bit of a conflict there. We'll take a look at the forecast charts here in just a second. Now, as far as some of the analogs are concerned, I mentioned that the La Nina is expected to be fairly weak, and looking historically at the current sea surface temperature anomaly pattern across the globe, we see that there are 3 years that are relatively similar, and they all indicate that La Nina will develop, but it will be weak. And it does look like the weak La Nina will fade early next year, and a reversal to potentially an El Nino the second half of 2018 is likely. So we're in this fluctuating ENSO condition since that 2015-2016 El Nino episode. We've seen a weak La Nina, a weak El Nino, and that sort of back and forth is likely to continue into 2018. The Atlantic is warmer than normal. I mentioned that earlier. And looking at the constructed analog forecast, it doesn't look like that's going to change much for the rest of 2017. So that warming influence from the Atlantic on the European climate in particular is a mild influence, and that's going to continue well into the winter season. You can see that there is some cooling early next year, then we're right back into the warmer than normal North Atlantic scenario for much of 2018. Now, the warm phase of the Atlantic multi-decadal oscillation is key to drought conditions in the U.S. and also above normal tropical cyclone activity. So we'll be looking at another drought risk and a big hurricane year for next year. Now, I mentioned earlier that the La Nina is expected to be fairly weak, and we're pretty confident about that. The reason is that the Pacific decadal oscillation is trending towards the weak cool phase. It's been in the warm phase the last 3 or 4 years. But we don't expect the trend towards the cool phase to last very long. It's going to reverse back into the warm phase next year. The Pacific decadal oscillation parallels ENSO, so we would be seeing a cool phase of the PDO evolving over the next 3 to 6 months if the La Nina that's trying to develop right now was going to be intense and last very long. So we don't see that. So the confidence in the La Nina developing is quite high, but we don't expect the La Nina event to be very strong or last very long, going back to the neutral phase next year, and the PDO parallels that. I am concerned about the Indian Ocean dipole. It's forecast by the Bureau of Meteorology Australia, and they're the experts in this, to remain in neutral phase going forward into 2018. But there are some signs of positive phase may develop. So we're going to be keeping a close eye on this for you. It's important because if the positive phase does develop, that means that the drought condition across Australia could amplify and worsen as we go through the summer season. The La Nina that's forecast to develop is in conflict with that forecast because it does support wetter weather over eastern Australia, and you'll see that the forecasts are showing that, but the confidence is fairly low right now. So let's begin with the forecasts. Let's go down to Brazil and Argentina. The October-November harvest is expected to feature more dry weather across the dry soils of Brazil. It's been bad down there. The soil moisture is quite dry, especially away from the coastal areas, Mato Grosso down into southeast portions, and that's going to continue through the harvest season. Just the opposite of that, no surprise here, soils have been very wet over parts of Argentina and the growing areas. The forecast is for more wet weather over northeast Argentina and northern Argentina as we go through the next couple of months. Cooler than normal temperatures across much of Argentina, while Brazil will maintain that hot regime with a dry climate that's forecast there. Now, as we get into December and early next year, January, that La Nina climate is starting to take hold. It's a weak La Nina, but it's strong enough to produce some wet weather over eastern Brazil. So the drought condition over eastern portions of Brazil looks like it will try to ease once we go through midsummer, but areas to the west of that are probably going to hang on to the drought. In northeastern portions of Argentina and northern Argentina, where it's been wet, the climate pattern is going to reverse. It's going to turn drier. But is it dry enough to reverse this very wet soil condition down there in midsummer? It's going to try, but we don't think that there'll be any change in the prevailing soil moisture towards a drier drought condition. But there is a pattern change ahead for late this year, early next year, with a drier climate for northeast Argentina. Now the soil moisture conditions, obviously, we've had that very dry condition across Brazil that I mentioned, and there's going to be some relief over far eastern portions of Brazil. The wet conditions across Argentina, quite profound, especially northeast Argentina, but we are looking at a drier climate eventually forming there due to the weak La Nina condition in December and into January. It's not going to be strong enough, this dryness, to reverse the wet soils down there into a dry or drought condition. As I mentioned earlier, the La Nina probably won't last much longer than early next year as we come out of La Nina and back into a neutral ENSO condition. Now, we're very concerned about Australia. There's a drought condition going on down there. There was drought earlier in the year for the wheat areas in southwest Argentina. That drought area has lifted further north into northwest Australia over the last couple of months. But the eastern portions of Australia are very dry. Now, we're hoping that this La Nina condition, which does favor a wetter climate, can produce some beneficial rains as we get into the summer season. Now, looking at the constructed analog that's driving the forecast and some of the probability forecasts, taking a consensus of all of those views, it does look like it's going to turn wetter over eastern portions of Australia. So some relief is on the way for the drought condition in far east and far southeastern portions of Australia. Still dry over western Australia. Now, I mentioned earlier this Indian Ocean dipole factor is very big. If it remains in neutral phase as forecast, we're confident that the forecast that I'm showing you here today will work out with the wetter weather ahead. But if we do get what's currently unforecast, a positive phase of the Indian Ocean dipole to develop, then the dry conditions are going to linger right through the summer season and negate the effects, the wet effects of La Nina. As we move into the early portion of next year, harvest across eastern portions of Australia, the wet condition is going to linger as La Nina is still hanging in there. Right after February, as we get into March and April, a drier climate will be returning. But right now, we're looking at a wetter scenario for early next year to benefit the drought condition that's in eastern Australia. So good news there. You can see the drought condition here, the current conditions, very profound characteristics over eastern Australia right now, but we do expect at least the eastern portions of that drought area to ease as rains come in for the upcoming summer season. The drought condition over northwest Australia is likely to continue. Now, I mentioned earlier the warm conditions over the North Atlantic mean a warm winter ahead across Europe. But the dry conditions, which have been quite consistent over southern Europe for much of the summer and early autumn of 2017, look like they're going to redevelop for the winter season. There's been some pretty prominent rainfall over the last month or so in parts of southeast Europe, but that's going to go away. It looks dry for the upcoming winter season. Across Russia, the probability forecasts are showing it to be warm, but as I mentioned earlier, we're concerned that some high latitude blocking high pressure will develop, and that will at times produce some marginally cold weather for Russia. We're not looking at locked in Arctic air, but on occasion it will be quite cold. Already snow cover is ahead of schedule over Russia, but we're not looking at an unusually cold winter across Russia. Now, moving ahead to the planting season across Europe, it's a tale of two climates, very wet over eastern portions of Europe and into southeast portions, whereas Western Europe, which is very dry coming out of winter, will maintain that dry to drought condition with a very dry forecast indicated for next spring. As we get into Russia for next spring, the planting season looks pretty good. Looks like wet weather is going to be pretty dominant, a showery regime over western Russia. As we get down into the Black Sea region and also Ukraine, it's also essentially near normal precipitation or on the wet side, so we're not expecting any indications of dry or drought conditions developing during the planting season. Let's come back to the United States just for a second. We are expecting mid-latitude cold weather for the winter season, and that looks like the best setup for that is going to be in the Midwest United States. But for the upcoming winter season across the United States, it's the battle of two types of climate. There'll be some Arctic air, finding a source region in western Canada that'll come down into the U.S. sometimes, right into the Chicago area, the Midwest area, above normal snowfalls likely. But in the absence of that pattern, mild Pacific influence will blow out that very cold air, and there will be stretches of mild weather. So a very volatile winter pattern is ahead, but averaging colder than normal and snowier than normal over the Midwest. The southern portion of the United States looks like it's going to head towards drought. The mid-south United States is already headed that way. Planting season next year, colder than normal weather will linger into the spring season across the northern U.S., along with rainfall, but the drought condition that's developing over the next few months, the last quarter of 2017, is going to start expanding northward into the central Great Plains during spring planting season. Where's the ridge pattern going to be for Northern Hemisphere summertime next year? Right now, it looks like the ridge pattern over Europe is going to be there. It'll be very strong, but over Northern Europe, not so much the growing areas to the south. And a wet trough is forecast to develop over the western portions of Europe. This is based on the constructed analog that I showed you earlier. And you can see the edge of that big ridge pattern over Northern Europe on the Russia outlook. This forecast looks very similar to what we had this past summer, a showery trough over west central and central portions of Russia. But as we trend down towards the Black Sea region and Ukraine, we start getting into a drier climate, and eventually hot weather will be developing there as we get into the second half of the summer of next year. That's what we're looking at for a long lead outlook. And finally, in the United States, the big ridge is expected to be over the western U.S. for next summer season. A cool trough over the southeastern U.S., but in the Great Plains, the growing areas, we're on the dry side of that trough. So we're expecting dry to drought conditions may be developing in the Great Plains, the central and southern plains, for next summer. So in summary, what we're concerned about in the short term, and this is a chart that will cover all the growing areas across the globe, but what we're concerned about in the short term, will the Brazilian drought end and reverse because of the La Nina that's coming in? We do think that eastern Brazil will turn wet. Argentina is quite wet. Eventually they'll get into a drier climate as we get into late this year and early next year, mid to late summer. Across Europe, it's been very dry over southern Europe. That's going to continue for upcoming winter season. In Russia, there's been some dry climate there as well. That looks like it's going to reverse towards a wetter regime. It'll be a very volatile pattern across part of the eastern portion, southeastern portion of Europe and into western Russia, as you saw earlier charts from winter through the spring and into next summer season. So no consistent, long-lasting climate pattern there, very volatile. And in the United States, we are looking for a dry condition to develop over the winter season in the Mid-South to spread into the Southeast states, and then that dryness lifts north into the Great Plains for next summer. Thank you for watching today. I'm Scott Euchness for Climate Impact Company.